A few weeks ago, oil traders around the world started watching a very small stretch of water, just 21 miles wide. Not Wall Street, not Washington. A narrow shipping lane between Iran and Oman, and suddenly, the global economy began to hold its breath. Because when tensions around Iran escalated, something strange happened. Oil tankers stopped moving, prices started jumping, and economists began whispering a word the world hasn't heard in years: stagflation. The uncomfortable truth is this: the United States might be the largest economy in the world, but the stability of that economy still depends on oil flowing smoothly through one of the most fragile choke points on Earth. And right now, that choke point is under pressure. In recent days, tensions between Iran, the United States, and regional allies have escalated sharply across the Persian Gulf. Energy markets reacted immediately. Oil prices surged above $100 per barrel, the highest level in years, as traders feared disruptions to global supply. Why? Because nearly 1/5 of the world's oil supply travels through a single passage, the Strait of Hormuz. Every day, millions of barrels leave the Gulf, from Saudi Arabia, from Iraq, from Kuwait, from the United Arab Emirates, all funneling through that narrow corridor before reaching global markets. If that route slows down, even slightly, the entire global economy feels it. And recently, it nearly did. Shipping traffic dropped dramatically after attacks on tankers and rising military threats in the region. Tankers hesitated. Insurance costs exploded. Markets panicked. And suddenly, a geopolitical conflict thousands of miles away started influencing gas prices in the United States. Here's the uncomfortable part. Oil markets don't need an actual shortage to panic. They only need fear of a shortage. When traders believe supply might disappear, prices jump instantly. That's exactly what happened. Analysts estimate global markets began pricing in the possible loss of 7 to 11 million barrels of oil per day if the conflict escalates further. That would be one of the biggest energy disruptions in modern history, potentially larger than the shocks that triggered the 1970s oil crisis. And that's where the real risk to the US economy begins. Energy is not just another industry. It is the input cost of everything. When oil rises, transportation costs rise. Shipping becomes expensive. Airlines raise ticket prices. Factories pay more to produce goods. Even food becomes more expensive because agriculture relies heavily on fuel and fertilizers made from oil and gas. Economists are already warning that the Iran conflict could push the world toward another period of slow growth, combined with rising prices. In other words, the same economic nightmare that haunted the 1970s, stagflation. And modern economies might be even more vulnerable today, because the global system now runs on extremely fragile supply chains. Factories rely on just-in-time deliveries. Retailers operate with minimal inventory. Shipping networks run on tight margins. That efficiency makes the system fast, but it also makes it fragile. If oil prices jump suddenly, the shock spreads everywhere. Logistics slows. Consumer spending weakens. Companies cut investment. And financial markets react quickly. Stock markets hate uncertainty. And energy shocks create enormous uncertainty. But there's another layer to this story, one that rarely gets discussed outside financial circles. For decades, global oil trade has been closely tied to the US dollar. Most oil transactions around the world are priced and settled in dollars. That system helps maintain global demand for the US currency. It also allows the United States to finance massive deficits more easily than most countries. But geopolitical tensions in the Middle East occasionally challenge that system. If global energy markets become more politically fragmented, if countries begin trading oil in different currencies, The long-term consequences could quietly weaken the financial architecture supporting the American economy. Not overnight, but slowly. And markets tend to notice slow structural shifts long before politicians do. Now, to be clear, no one is predicting that Arab oil producers are planning to crash the U.S. economy. In fact, many Gulf states remain close economic partners with Washington, but energy markets operate on incentives. Higher oil prices often benefit exporting countries, and when geopolitical tensions rise, production decisions become more strategic, reduce supply slightly, and prices can surge, increase supply, and markets calm down. That leverage makes oil one of the most powerful geopolitical tools on Earth, even when no one intends to use it that way. Which brings us back to today. Energy companies are already scrambling to reroute shipments. Some producers are diverting oil through alternative pipelines to avoid the Strait of Hormuz. Governments are discussing releasing strategic reserves, and markets are watching every headline from the Middle East because the modern economy runs on a delicate balance. Confidence, energy supply, and global stability. If even one of those pillars cracks, the consequences spread quickly. The strange thing about economic crises is that they rarely start where people expect. The 2008 crisis began in housing. The pandemic crisis began with a virus. And the next major shock could begin with something as simple as oil tankers hesitating to sail through a narrow stretch of water, 20 miles wide. So the real question is no longer whether the United States is powerful. The real question is something much more uncomfortable. In a world where energy still shapes global power, how dependent is the modern American economy on a region it can never fully control?